Afternoon, everybody. Today is the fourth session of our four-session webinar, so it's the last session. I'm very excited that so many of you have been continuing to follow this webinar, looking for one week to learn at who's been attending. It's been really nice to see that, at least to take it as a sign of the fact that you've continued to show interest. And so I'm very, very touched by this, and I appreciate it very much. Louisa, unfortunately, was not able to introduce the topic today, as she has the SIT going on actually today and tomorrow. And Denise, I wanted to thank you for helping coordinate all of these events and for helping me with all the logistics and also the content of the slides. So I very much appreciate that. So today we're going to talk about killer financial KPIs. Just a quick look at what we've talked about so far. We've talked about the capital structure and how it affects fundraising. We've talked about fundraising valuation, what to look at, and how to value your company. We've talked about business model, in particular, what's your scaling and your growth story. And so today we're going to talk about financial KPIs that could kill your company. Let's recap what are the main lessons of the webinars, the three webinars that we've gone through already. In the capital structure webinar, actually I'm going to talk without putting my video just to make sure that the bandwidth is not affected and that you could hear me correctly. Either way, my video is not needed. What's important is the explanation of all these slides. So in the first webinar, we talked about how you really need to have a good understanding and do careful planning before raising debt and equity. Understanding where they sit in your capital structure and what they mean, especially regarding how investors will react in good and in bad times. We've then moved on to VCs, who are a very unique type of investors. VCs invest in highly in businesses that have a very high rate of failure, over 80%. And so their approach is to invest in equity to get the upside, but insert a lot of debt features into their funding, so their equity funding. We've also, as we approach the valuation and fundraising, talked about how it's important to really put your best foot forward. Doing your fundraising and doing your business model is not enough. You need to do research on other startups, other fundraisers, how much they raise, what valuations, who did they raise it with, what VCs will be interested in hearing about, what VCs are focused on your industries, and understand how, when you forecast your business, what's the end goal? What companies that are mature company look like what you want to look like, and how research analysts look at them and their valuations, what they talk about in their annual presentations and reports, what kind of KPIs, financial and business, do they mention. Then when we started looking deeper into evaluation, we took a look at how valuation takes into account the upside of your business, but also the downside scenarios, particularly the risk of failure, the risk of dilution for future rounds, and other types of risks. And how also it takes into account the multiple of money that venture capital firms expect when they invest. We, in the same webinar, and actually in webinar number 3, talked also about how to approach fundraising, that the fact that you should aim to have 18 to 20 months of cash. We'll talk about it today again. That you shouldn't spend more than 4 to 6 months actually fundraising. But it's very important that when you start fundraising, the day that you consider is the start of your fundraising day, you've already have done a lot of work ahead of that, knowing and talking to specific VCs, refining which VCs are going to be investing in your business, already have soft commitments, already have an understanding of what questions they have, what they're looking at in your business, what they're afraid of, how they see your risk, how much money they're going to be putting, if they think you should be raising more or less, and what legal documents they're going to want to look at, what documents they want in your data room, et cetera, et cetera. So we talked about all of that. Because every month that you spend fundraising, you're not spending it selling to clients. And number one rule of running a business is that your funding should come more from your clients than from equity investors. Another thing that we talked about, in particular in the scaling and the growth story part of these webinars, webinar number 3, we talked about how raising fund is, you need to look at it from a value to you perspective. It's not just money. Does it fit within your growth? Are you raising fund for defensive purposes? I need to accelerate really fast before someone comes into my market. Or accretive, if I can raise money, I can buy all these other companies. I can grow in a much faster way and generate more value, have higher margins faster. So really focus on how fundraising, how the additional raising helps you generate more revenue. And the important part here also of the story is that fundraising is to generate more revenues and to create higher margins. It's not to cover losses. In that webinar number 3, we also talked about how scaling is about growing revenues and margins. That's just what I said, actually. And that's very important to present that story in details with business economics and KPIs aligned with your clients. How many revenues per client per year? What's your gross margin per client per year? What's your impact per client per year? Just sort of bring it to unit economics, and then be able to talk about it, how it changes over time and through the fundraising. What's your sales pipeline, et cetera, et cetera. And then some things that we've mentioned through all of these webinars is there's a lot of information, of free information online. This information will cover all the topics that you need to know. So really use this webinar as a starting point and go do deep dives through YC, through blogs of venture capital funds, through a number of online resources. There's a lot of videos, there's a lot of books that have been written about it. So really take the basis of this webinar and really using it as a guiding point towards more knowledge out there. And really use also other local VCs, local entrepreneurs, and databases that'll tell you a lot also about what's going on in the market and what the best practices are. So today we're going to talk about financial KPIs. There's 3 main concepts that we're going to cover today. One is that cash is the most valuable resource of your company, so understand it and make it count. You don't have a cash, you don't have a business. You know, when I look at this statement, I also feel like it's important that there's other very valuable resources of your company. It may include people, it may include, you know, certainly people are extremely valuable, but you could create an activity without money, and it's not a business. So when you're thinking about business, it's sort of, money is the most valuable resource. And people and corporate culture is obviously extremely important. There's many other things, but really here the point of this financial management is to insist on the value of the importance of cash, how you need to understand it, and how you need to make it count for you and for your business. And today we're going to do the second concept. There's 2 metrics that we're going to focus on. One is working capital, and the other one is customer acquisition cost. These are very important metrics, and we're going to go through in detail about why it's important for you to really master them and make them work for you. And then, in fact, that's the third point, the implication of good financial management. So if you're a CEO of a company and you're the founder of your company, you're using those metrics to avoid bankruptcy, but also to adjust your strategy. And those strategy decisions that you're making out of those KPIs show that you're smarter and you have good financial management practices. So that means, for example, adjusting your distribution channels or your customer segments to lower your cash burn, or to lower the investment that you put into acquiring your customers. So one slide on quick quotes. I really like this quote about the sun also rises from Ernest Hemingway. And so there's a moment in the book where one of the protagonists, Bill, is asking this other person, So how did you go bankrupt? And the other person says 2 ways, gradually and then suddenly. And this is because just when you start realizing that you're about to go bankrupt, then things accelerate, and then you lose your money and you have to close your business very, very fast. There's a single story of a business that had to raise money to not go bankrupt, or that had to seek protection from bankruptcy. With 6 or 9 or 12 months of planning, they always realized really in the nick of time. So it's always important to think about how can you anticipate ahead of time with the right metrics to avoid bankruptcy, because when it happens, it's very sudden. And then the entrepreneur journey, and this is sort of something that I experienced myself, so I don't know if this is a shameless plug of my own experience and my own quote, or someone told me this, but when I was an entrepreneur, I thought, and entrepreneurs come to me and they say, oh, I sold to a client, and I say, where's the contract that's been signed? And they say, oh, I'm signing it tomorrow. The rule number 1 is you haven't sold until the contract is signed. And in fact, once you sign a contract, you realize that this is not the end of your work. The new rule number 1 is you haven't sold until you put that money in the bank. And that is a good way into reminding you, just this slide, I wanted to put it there, but the reasons why your startup fail, you run out of cash is number 2, pricing cost issues is very aligned with that, and then product without a business model, and that really aligns with the customer acquisition costs. We'll talk about it when I make that quick statement. But my point about the new rule number 1 applies to customer working capital. So I'd like to start a poll here, and I'm curious to understand how you are looking at it. So if you could tell me which statement most apply to how you look at cash. Is it hard? The statement that applies to you is that it's hard to raise cash, or from your perspective, you say, oh, you know, actually I understand where I spend my cash. That's my position towards my cash situation. Perhaps you're also thinking, more than that, I know actually how many months of cash on hand I have, so I'm able to plan ahead, if you will. And then option number D is I don't waste time on small cash expenses. So I look at the big items in my big cash expenses. I really don't look at the small stuff. I don't want to sweat it. You know, this is small stuff. It doesn't matter. So let's see how the polls are coming back. That's interesting. So I know how many months of cash on hand I have, about 50%. I understand where I spend my cash. That's good. And it seems like nobody's into not looking at the small cash expenses, and that's very good. Let me copy this. So with that said, we can go to the next slide and then start talking about those small expenses that add up, and how does that fit into the difficulty of raising cash. So how much cash do you have on hand? There was a survey a couple of years ago that I thought was very interesting. So JP Morgan surveyed basically nearly 600,000 small businesses in 2015 to try to understand what was their cash situation in comparison to their ongoing expenses. What you can see here is actually an interesting picture per industry of how many days of cash they had on hand. And for restaurants, 16 days, that's really not a lot. I was really impressed also at construction. In construction, they basically have less than a month of cash on hand. In the US, I see that because they might pay their construction workers every week. So in other words, they manage that really cash in, cash out, and they're in the construction business, you might be very tight, or your client might be very tight in spending and making sure that you're advancing to make sure, because I mean, so often construction companies go over budget or over the time frame. I thought it was interesting. Is a high-tech services, 33 days is basically 1 month of salary. I thought that was interesting. And so you compare this 27 days of cash to what I was saying in webinar number 1 and webinar number 2 about how basically the average amount of cash the company raise when they raise cash needs to take into account the fundraising between rounds. And so what you're looking here on the right side of that slide is that it takes you about 18 months to 22 months to raise money on average. And so you look at a startup and you see what's the difference here between a startup and a small business that perhaps is not a high growth business. So I thought this is at least an interesting starting point to start considering that a startup is a unique business, that it's got a particular different relationship to cash. I would say in general, if you're not in the fundraising mode, anywhere between 6 months to a year is good enough. I remember, I think, seeing something about Bill Gates in his early years saying he always wanted to have a year's worth of salary in cash to be safe. So I thought that was quite interesting. Anyways, this is at least to give you some background on how you should be looking at it. I wanted to start, before we get into some translations, have at least everybody understand the same words in the same way. Days on hand, so that would be total cash available. So days of cash on hand would be total cash available divided by the sum of recurring expenses multiplied by the number of days in that period. So if you're saying I'm looking at, I really want to have a year's worth, a full year in view when I take in consideration when I do my calculation. So you might take a year's worth of expenses and then you divide it by 365, and that'll give you a day's view of a year's worth of expenses in terms of cash on hand. Working capital is essentially the difference between your current assets and then your current liabilities. And your current assets is anything that basically becomes cash in less than 12 months, and then current liabilities is anything that you have to pay in less than 12 months. So that it's, on your current assets, it's what customers will owe you, goods that are sellable within a year typically, and then on the liability side, so any short-term debts that you have, perhaps you have a factoring, where you have to pay someone, they advance you some money based on receivables, and you have to pay them, or trade financing, for example, short-term loans that are less than a year, and then anything that you owe to your suppliers. And then also one thing that I think here goes a little bit into the core of our business is you're looking at or when you're looking at public equities financial statements, most of the time they report in accrual accounting. And accrual accounting essentially is a way to record, to make it easy to understand your business activity by recording revenues and costs at the same time when an event is incurred. So let's say in April, you recorded a sale for which you're incurring that sale of April, you signed a contract. So in your book, you're going to say, I recorded a sale, but you're only going to get paid in July. And in fact, you incurred a cost for that sale. Your supplier cost was incurred in January. Well, all of that is going to be recorded in accrual basis in April to show the margin allocated to that to the economics of that event. So that's what happens in your income statement, which is why you have a balance sheet that will report in your balance sheet that you'll report in April that you actually have receivables from your client that will get paid in July, and then it has already reported that as of January you needed to pay your supplier. So that's how it gets reflected, and the document that will show all that cash basis will be your cash flow statement. In particular, the working capital is typically shown in the first section of your cash flow statement, which is your cash flow from operations part. So that's a little bit of technical accounting, but if you're someone who's done investments, that's an important way to look at it. There was a question about EBITDA, and EBITDA is accrual accounting, operational profit. And so the difference, again, accrual accounting is it's a simplified view of all your business events and how cash is reported and seen to show the margins. In a startup, if you're looking at EBITDA margins and then you've got huge delays and when sales are reported, the costs are incurred, et cetera, it's really hard to recognize what the margins are. So that's why you have accrual accounting. And so the equivalent of EBITDA in your accrual accounting, you would go to look at the real view of EBITDA from a cash flow perspective, you would go to your operating income in your cash flow statement. Now let's go through some calculation of working capital, which is the basis behind the concept of accrual accounting and how to understand it. So I'm going to go through right now. I'm going to share share my Excel spreadsheet, a little model that I built for the purpose of this. I basically built two cases. One, where this is, if you will, the simplified view of your business. Let's take a look at it. I've got three schedules here. One part, that first section, which goes over the recording of recording of your cash flows from revenues. So here you would be saying, these are the revenues that I get for all my clients. And then in your business model, you're saying, I'm signing clients here, for example, client number 1 on month 2. And the way it's broken down is that you're saying, every client I sell to, I'm earning 100. They're paying 0 at signature of the contract. So they're paying 50% 1 month after the signature of the contract, and then the remainder, which would be the next 50%, 3 months after the start of the contract. So which would mean that for client number 1, we on month 1 would have our sale. We would be paid 1 month after the signature, so we would have 50 in our bank account, and then 3 months after the start of the contract on month 4, another 50. And so that would the same thing would apply to client 1, client 2, client 3, client 4, and client 5. And so as you can see here, client 2 sale is recorded on month number 4, so we get paid 50 on month number 5, and then another 50 on month number 7, and so on and so forth. So again, here we earn 100 with clients. They pay 0% at signature. They pay 50 1 month after the signature, 50%, and they pay 50% 3 months after signature. Let's take a look at our cost and profit schedule. Just looking at the cost, I wanted to simplify here for the sake of really simplifying what working capital is and how it affects your business. I wanted to simplify the production and the production of your products aspect, and rather than put a mix of, you've got suppliers, you've got freight, and you've got engineers who are and perhaps manufacturing internally. Here, let's assume that you're manufacturing everything through a third party that's going to charge you. So you're going to make a 50% margin. They're going to charge you 0% signature. You've negotiated that with them because you're really good at negotiating. And they're going to owe you basically on the same timeline as everything that you record from your clients. So 50% 1 month after the signature of your client. So for client number 1, you recorded 50 and you're going to record 25. And the next 50, you're going to record it on the same time as you record the 25 here, because we've established that you'll pay your supplier every time that you get money from your clients. So that's the way you're thinking, or I would be thinking in a simple business plan about trying to make sure that I minimize the cash I need. So when I replicate this from 1 client to 5 clients, and all the manufacturing of the products I need for those 5 clients, I get basically to this framework where in year one, because of the timing, the lead time of getting the money, I registered 450 in sales and 225 in costs associated to my business. I've determined also that I'm paying myself all costs included, not just my salary, but also the overhead, Social Security and all that stuff of 60. And then I've got other staff and expenses of 200, legal expenses, accounting expenses, consultants, etc. And engineers, sales staff, and all that stuff goes into the other staff and expenses of 200. So this would be the final profit at the end of the day. Now, if I'm just looking at it, I'm looking at this and saying, okay, well, really here, the minimum amount of money that I need to fund my business would be 22. Well, it doesn't really work like this. This is where your cash balance is important. So you're, because you're planning ahead, and in fact, most of you are, per the poll, you're saying, well, I'm going to have, say, 3 months salary with a starting cash balance of 100. So I need money ahead of starting my business. I'm going to put 100 in my bank account, and I want to make sure that every single month that happens, I always have at least 3 months of salary. And so looking at these salaries and expenses, on ongoing expenses, that 3 months is 65. And so that means that when I'm looking at month one where I had 100, but I lost 22, essentially my ending balance is 78. It's still above the 65, so I don't need money. And so as you look at the activity month over month, then you start realizing actually in month 7, you're at actually in month 6, you end your month with a cash balance of 45. So technically here, you would say, this is the month where I need my 20. So you would need 20 in your business. So you would need 20, you need to raise 20 to fund that business plan. Well, this is a simple business plan. And in reality, you're going to say, well, actually, this is not going to happen like this. And so here's the case where you start including some aspects of real world working capital impact. So let's take a look at the revenue part. Here, we'll just assume that you're still earning 100 per client, but you're going to really negotiate them with them really hard on getting an upfront payment. So you're going to say, I want 30% at signature. And you're going to say, oh, that's really good. In my business plan, it means that I don't need to have to raise even the 20 perhaps. And you're going to say, okay, but against that, okay, if you're not paying me 50 1 month after signature, you're paying me 30% at signature, and then 30% 1 month after signature. And then you're paying the remainder 3 months after starts. So they'll say, yeah, no problem, just send me the invoice and I'll pay you. And they'll say, oh, by the way, we're a busy firm, so yeah, it might take us 3 months to pay you once we receive the invoice. So you're saying, okay, well, I really need to hurry up with the invoice, but you're going to be busy also. So let's say it takes you 1 month to generate the invoice. And so you're going to have another 3 months after that before you get paid, because they're really going to try to delay when paying you. And so that client that you signed in month 1, that initially in your business plan you're getting 50 from in month 2, you're getting 30 in month 5. And it's taking you 8 months to recover all of your money. And so that's the impact of that lead time, and that's really going to affect your cash burn. So for the sake of being nice, we've also looked at in nice terms on the supplier side. Let's just say you go to your supplier and say, I'm going to pay you when I get my money from my client. They're going to say, nah, hold on here. We've got plenty of other clients. So we know you're a startup. We don't want to take risk with you because we've dealt with startups before, and so many of them, in fact, didn't end up paying us because they managed our cash really well. So we want 40% at signature, and we want you to pay. So this is the 40% here, and we want you to pay us at a maximum within 2 months of when you sign your client. And don't worry, we'll issue our invoice really fast, so we'll be counting the time, but we're not, in fact, we're really going to be on your case about this, and yeah, sure, we'll be fine with keeping the other terms of the contract in line with your clients, which is 30% 1 month after signature, and then 3%, like the remainder, so another 30%, 3 months after start. So when you're looking at client number 1, here and here. For client number 1, we've established that you're earning 30 in month number 5, and then 30 in month number 6, and then 30 again, and then 40 in month number 8. That's because you have to invoice before they acknowledge payments for you, and they take 3 months to pay you, and then you've scheduled something where they pay you 30% after they've received the signature invoice, and 30% after they've received the invoice for the 1 month after the signature invoice, and then another 40% 3 months after the start of after the signature. And on the supply expense for client number 1, basically the same structure, except they want 40% at signature, and they're only going to get paid at 60 days, not at 90 days. That's 2 months. So you're seeing month basically for an event that happened in month number 1, it would be fully recorded in accrual accounting in month number 1. You're recording it on your cash flow basis. In month number 4, you're recording an expense for your supplier of -20, and then another expense in month number 5 of -15. And so at the end of month number 5, so 4 months after you've made your sale, you're still -5 for that specific client on that specific product. Month number 6, you are plus 25. So you've recorded 60 and you've incurred 35 in expenses. Month number 7, you're at that point just really close to break even because you're recording 60 and then you've incurred 50, you're 50 of expenses. And then basically it means that at month number 6, you start incurring profit on a sale that happened 5 months prior. We're getting now into the concept of working capital. That you don't get paid when you think you're going to get paid, and oftentimes you need to pay way ahead of when you're getting paid. And so your salary and your other staff expenses that we've already established that is a monthly constant number. Now let's take a look at the starting cash balance. So before we do that, actually, I wanted to take a look at the totals. So we went from recording 450 in our simple business model to one where we integrate working capital and lead time of 290. And we know that we have 210 of revenues that are receivables at the end of that period. And the same thing from the supply cost basis. We have 185 in receivables, in cost incurred, and then 65 in expenses that we're going to have to pay that are going to be associated with that 210 in receivables. So let's take a look quickly at the cash balance. So we have the same cash balance of 100 at the start and 3 months of salaries that we want to keep. And the monthly cash need now, if you look at it, basically if we take the minimum of all these numbers, which is happening in month number 10 and month number 7, is 127. So if we integrate working capital into our business plan, we basically multiply by 6 the amount of capital that we need. Let's go back to the presentation here. These are the things that you really need to pay attention to. So I've talked about it a lot. You'll have the video to be able to go over these concepts again in detail, and then really be able to slow down certain parts that perhaps I may have gone a little bit too fast over. Apologies for that. What does it mean? What does this all mean to you? So we've gone over the calculations. We've established that it's important to take into account working capital, the difference between when you think you recorded cash and when you actually get it, and the difference between when you need to pay for products that you sell and when you're incurring the revenues, when you're getting the cash into your bank account from products that you sell. And that difference has a big implication for a lot of elements from your business. But if you're trying to be the proactive entrepreneurs that you are, you're thinking, okay, well, it's not just about avoiding bankruptcy. How do I make this an asset for me? And so let's take a look at the sequence of 4 steps about how you make this an asset for you. First of all, use it, as we said, as a KPI to manage your business by prioritizing low working capital activities. So working capital will change per type of product. Some that are where you have to pay your supplier way ahead of the time, perhaps some others where you actually can pay your supplier after time or when it happens or when you get paid. That may change based on product. It may change based on your pricing model. Perhaps if you tie your supplier with a client and the supplier trusts your client, and essentially you establish direct payment from your client to your supplier, maybe that reduces, is one way to reduce how how much you need to pay your supplier ahead of time. So that's, you can also integrate your supplier in your cost structure. Actually, this would be a way to spend more ahead of time in certain areas also. So that's an important element. Your distribution channel also might affect how much you need ahead of time. The second step, when you take into account all these elements of your business and start saying, okay, where do I spend most of my cash ahead of the revenue that I earn? Then think about which customer segments you have. That's the next step. Which customers really are forcing me to incur revenue in the latest way, and then are generating basically the most risk on how much revenue I'm going to have from them. So are there segments where you need to advance money ahead of time versus segments where you don't in terms of customer segments? Perhaps B2B, you need to advance money ahead of time and they won't pay you ahead of time, versus retail, well, they'll pay you on the spot. That's one example. Is there a version of the product that you sell or something that your business is good at where clients are willing to pay ahead of time, which would lower your working capital? And step number 3, better scale. What is your working capital need for each client? Once you've understood that and your KPIs that affect your working capital, how does that change if you have 1,000 times the number of clients that you have right now? Or what about 1,000,000 times? How do you integrate that into your scaling story? Step number 4, this will all lead to you better determining what capital you need to grow your business, and ultimately how you're able to not only manage your receivable and payable, but also manage your source of funding. For example, perhaps you don't need to raise equity if you know that basically for every client you have a 3-month gap that you're really good at managing, then perhaps you just go to a bank and get factoring. Perhaps if you're just shipping things across from one country to another, perhaps you get trade financing. So there's many ways that where you don't need to dilute your equity, and where you can really go back to your capital structure and determine that there's better types of cash that can help you with your cash needs based on what your working capital is. So let's do poll number 2 and talk a little bit about customer acquisition. So in your mind, how much does it cost you to acquire a paying customer? The poll just popped up. Answer A, is it 4 calls and 6 subway tickets if you live in Paris or Lisbon or London? Is it 300 euros, for example, if you're at e-commerce? Maybe that's it, maybe it's less. These are just numbers to try to get a sense of how you, if you know it, and how big it is, And obviously, it's going to depend on what kind of clients you have. Could be 300 euros. For some, it's going to be 1,500 euros. For some, it's going to be 40,000 euros. And then for some of you, you're actually quite advanced in your thinking, and you're saying, well, actually, it's less than a third of its lifetime value. So I'll let you answer all of this. I have to say that I'm quite impressed with some of these answers I've had to these results. Okay, so these are the results. Nearly 50% of you, less than a third of the lifetime value of the client, and then 30% of you said 300 euros, and some of you said, actually, it's quite expensive for me to acquire clients. So that's very interesting. Let's take a look at some of the concepts. 5 reasons why customer acquisition cost is not as important is critical. One, it's just about always the most important use of raised capital. So a lot of the money that you raise is to acquire customers. So it's really important to know how much it costs you per customer. And the second reason, it's always higher than what you think it is. That certainly was my experience when I was an entrepreneur. Is the same experience that every startup I've worked with or I've advised has. So it's always higher than what you think. 3, the compounding effect of scaling will increase the speed of damage and likelihood of bankruptcy. And by that I mean, going back to that quote from The Sun Also Rises, how fast you go bankrupt is really tied to the compounding effect of the cost of customer acquisition and how different it is, or how much higher it is compared to what you had in your budget. A few examples of companies that failed or almost failed. Pets.com is a very standard story. I think they were acquiring they're spending $300 per customer, and the lifetime value was probably less than $50 per customer, or less than $100 per customer. So the way they were doing the calculation was they were spending a lot of online ads, and then the customers would come in the first time and spend perhaps $100, and that would turn into $10 of profit. These are not the right numbers, but I'm just giving you in concept what it means. Perhaps they were spending $300 per customer to acquire a customer. The customer would come in, bring them a net return to them, net revenue to them on that first purchase, $10. And then 50% of the customers would come in and generate another $10 within 6 months of that. And then 50% of those customers would generate another $10. So you see, basically, for all the customers they acquired, all the value that they generated per customer was quite low, and so they failed pretty quickly. Groupon, Living Social, I also knew personal entrepreneurs. One story that was famous at some point in New York was an entrepreneur who created a sort of Groupon for baby products, and they got basically a $60 million cash injection. So they were growing really fast, and they received $60 million at a $300 million valuation, I think. This was 2012. And then basically the investor at that point had come in as a majority, I think, investor or near majority, and they had sufficient rights to make pretty strong strategic decisions on the board and as a shareholder. And essentially 6 months after they came in, they closed company. They closed the shop. Because what they realized is actually the customer acquisition cost and the lifetime value made it a business where they were just spending on acquiring customers and not generating any value out of that. So they were in a money-losing business. Technically, their entire business was losing money, spending it on customers. That didn't bring them any profits. So also, most of the monthly boxes model, where you sell a box, someone spends $50 or 50 euros every month, and then you think they're going to be staying on for a year and a half, and in essence, they stay for 3 months. But your minimum break-even on all the money you had spent was typically 6 to 9 months to a year. And so you're basically, again, in a money-losing business. Reason number 4, it shows business. So here we've covered sort of that bankruptcy part. Now we're really getting into more of the strategic decision making. How do you make it count for you? Business acumen. It shows business acumen if you can prioritize your growth based on client segments with the highest lifetime value, and in comparison to the lowest customer acquisition cost. That's, you're already having a smart conversation with your investors about how you're looking at your business and what your unit economics are. And then 5, over time, it really shows the quality of your brand. And so normally you're supposed to demonstrate, if you're using this as a KPI, as a positive KPI, not as a let's avoid bankruptcy KPI, but as a we're a strong brand, we're a strong company KPI. You're going to show over time that your customer acquisition cost lowers, and it lowers because part of what makes it lower is the percentage of inbound unsolicited sales requests for which you didn't spend any money. And so, you know, that's just some thoughts ahead of time. How to calculate customer acquisition cost. I'm not going to spend too much time on this. There's some key concepts. One is customer visibility. So typically what people will say is that for SaaS companies, for example, you need to have a lifetime value that you look at it and say lifetime value is over a cycle of 5 years. And my customer, because you're going to establish that your customer visibility is 5 years of spending, I typically look at companies with, I look at companies as having 3 years of visibility. If you're an online retail, or if you're online business, if you're retail, if you're SaaS, you might perhaps have a strong visibility over 3 years. 5 years, I feel like, is pushing it. So typically, I'll talk to CEOs and say, try to look at your lifetime value over 3 years, and then your customer acquisition cost being half of that lifetime value in terms of net profit per customer. And if you're looking at it over 5 years, then you look at 3 times. So over 3 years, it's a little bit more aggressive, and over 3 times, over 5 years, it gives you a little bit more leniency. I'll talk about, I want to talk just quickly about selling, servicing, and retaining. So all the costs involved with that are specifically customer-centric. So you have obviously your product cost, but that's your net gross margin on your client. But you're incurring a lot of costs associated with acquiring and keeping your client. And the way good CEOs look at it is they build a customer success story. So they first acquire the customer, and they're trying to acquire with a minimal cost basis. So customer success, it means that certain customers are going to make it easy for you to acquire other customers. So you're going to have a low acquisition cost. Then you're going to be spending in servicing the customer. It's sort of a sales cost associated to that customer that are not necessarily related to your product. And then you're going to have costs associated with retaining your customer to try to make sure that it goes beyond perhaps the 3 years or that 5 year. Essentially, it's cheaper to retain a customer than to sell to a new customer. So that's why you should always focus on retaining that customer. The servicing part is really about how engaged your customer is with your product, and that's really generally good companies will have a client success dedicated staff. So you have customer acquisition, salespeople, customer onboarding, customer success, integration, use of the product, make sure they're using it the right way, getting feedback from the client product, and then sort of your retention process. So all of these costs, if you're really holistic about it, all of these costs will go into your full customer acquisition cost. But if you want to be simple and sort of straightforward, you would look at your customer acquisition cost as all your sales costs over a period of 1 year, let's say, all the clients that you signed, And you'll say, well, over that year, I spent this much acquiring customers, and that acquired this many customers. And in fact, we're going to go over a quick example. I wanted to, a fourth point I wanted to make about this, I talked about customer visibility, concept of selling, of servicing, of retaining, framing this around a customer success story and a customer success approach. We've talked about the lifetime value. I think most of you are familiar with the lifetime value and its relationship to customer acquisition cost. We've talked about the calculations, the simple calculation around the customer acquisition cost. Now, this is, again, the let's avoid bankruptcy aspect. When you're starting to say, let's make it a KPI that works for us and that allows us to make good strategic decisions for our business, then we're looking at how you separate your customer segments and your distribution channels and allocate for each of them a specific customer acquisition cost and customer experience cost, if you will. And that will allow you to separate and to prioritize those segments that have a low acquisition cost and a high lifetime value. So that's when you start making good decisions about your business. And so that's how you use that KPI from not just managing, avoiding bankruptcy into something that allows you to generate more value for your business. So let's go look quickly at an example of, now we're looking at the Excel spreadsheet. We're going to be looking at the proxy for a DP with a customer section schedule, which I included here. Here, if we say that every year, basically, we spend, if we have 3 salespeople and they all spend about 1,000 per year in transit, so we spend 3,000 in transit. They all spend 10 euros per month, all 3 of them per year, so 360 in phone bills. They'll go to conferences, trade shows, etc. Perhaps you'll have 1 trade show or 2 trade shows that you're going to spend money for. So you're going to spend 9,000 trade show. You're going to spend money on lunches with clients, prospects, coffees with clients and prospects, other marketing costs of 5,000, including lawyers perhaps. And so that brings you to a total cost for all the customers of 23,000, but that's not just all your customer acquisition costs, because in your customer acquisition costs, you need to take your own time that you spend. Perhaps 50% of your time is spent on customer acquisition, and then you need to include your sales staff. So Mike and Laura, who are your 2 salespeople, who have a total salary and overhead cost of 50,000, but that gets integrated in your customer acquisition cost. And so that means when you're looking at your working capital and all the expenses you have to generate those customers and how your cash flows impact your fundraising, that essentially, if you're looking at the monthly cash need, you're seeing that you went from negative, so a cash need of 127 in the previous example without integrating the customer acquisition cost, to now 146 in month number 10 here. Now in a bigger version. And so this is sort of how we have our scenario. In fact, in the previous scenario, we weren't integrating so much of our customer acquisition cost. We had a net profit per customer of 18. And now we're actually having a net profit per customer of negative 6.7. So now in this business model, we're going bankrupt straight away because we're losing money for each customer. So all these things are things you should think about. I'm now going to go back to the presentation. Again, you'll have this. I want to talk again about lead time when it comes to customer acquisition. Two parts. Two concepts around customer acquisition and how they impact cash need. One is the sales lead time, and the other one is the sales funnel. Sales lead time, it could take 3 years to negotiate a pilot after just meeting a corporate versus a small company. And so you really need to understand how that works. And how that affects your lead time, because this, lifetime value when you're looking at the next 3 years is 0 for a client that makes you sign a contract after 3 years. Just to be clear about this. So use this in your favor to minimize which customers you pursue first, okay? And then and how intensely you spend money on them. And then the other part is the sales funnel. When you build your business plan, it's very important to allocate the right amount of realistic conversion for each of your stages of client interaction. So a validated lead, perhaps it's a 2% chance of conversion. So a first call made, perhaps it's a 5% chance. A second call made, 10%, and so on and so forth. Where you get to a contract negotiation is perhaps 70% chance of conversion. 7 out of 10 clients you start a contract negotiation, you actually sign as a client or actually get money from. If you sign a client, 95 out of 100 clients that you sign will actually pay you the service. Perhaps 99 will actually pay you in the upfront payment and will actually pay you the service once you've received the upfront payment. So this is just a side point about how important it is to, when you think about your business plan, you've integrated your customer acquisition costs, you've integrated when they're going to pay you, how much you're going to have to advance, how much they're going to have to advance, what your pricing structure is. But it's also important to also allocate the right percentage of conversion for all the clients that you have in your pipeline. If you have 1,500 clients, 1,000 clients, you need to allocate this to make sure. Okay, and we're running almost out of time. I've made this point about client segments and prioritization. Really make sure that you use this KPI customer acquisition cost to understand each segment that you have and use it to your advantage to prioritize certain segments versus another. And use it also for the fundraising. When you fundraise, you need to be able to say that, if you're fundraising $1 million, 50% of this will go to customer acquisition, and it's broken down into 200 will go to this segment, and this is how it's broken down. You acquire, this is how much it costs you to acquire this many clients, et cetera, et cetera. So let's have a quick poll number 3. To conclude, what is the most important concept you learned during this series? First one is no financial sustainability equals no profit equals no impact, or no profit for the for-profit companies, or for the non-profit companies is no financial sustainability equals no impact. Option number B, venture investors are return maximizers and risk minimizers. The most important thing might be that it's clients, find them, get them to pay in advance, grow with them and repeat. This is a scaling story. Most important concept might be point number 4. The financial management is necessary to survive and required to succeed. Perhaps it's knowing what growth and success looks like and what failure looks like as well, and how it might help you establish the right valuation. Point number 6 is that really is a good starting point. There's a lot of free information out there. And the last point is really this webinar series are much better than the Netflix series I've been watching. Let's take a look at the results. Nobody chose option number 6. Okay, cool. Well, I'll put this and in the webinar. Thank you everybody for following this webinar. Looking really forward to hearing back from you and staying in touch. Feel free to contact us via email and via LinkedIn. Thank you so much, and bye-bye.